For many investors, income is just as important as growth. Dividends provide cash flow, reduce reliance on price appreciation, and can play a stabilizing role within a long-term investment portfolio. This video examines dividend characteristics within the Saudi stock market, whether Saudi companies pay dividends, how those dividends are accessed by American investors, and how dividend exposure from Saudi Arabia is typically positioned within a diversified portfolio. Saudi Arabia's stock market includes a large number of mature, cash-generating companies. These companies operate in sectors such as energy, banking, telecommunications, utilities, and infrastructure. These sectors often emphasize steady cash flows and shareholder distributions rather than aggressive growth strategies. As a result, dividend payments are a meaningful component of total returns for many Saudi equities. Unlike markets dominated by early-stage or high-growth companies, dividend culture plays a more prominent role across several segments of the Saudi market. Energy companies, particularly those connected to oil and gas production, generate significant cash flows during periods of strong commodity pricing. When revenues are elevated, dividend capacity often increases. However, payouts in the energy sector can fluctuate depending on pricing cycles and capital investment needs. Banking institutions represent another important source of dividend income. Saudi banks tend to operate within a well-capitalized system and often prioritize regular dividend distributions. These payouts are typically tied to lending activity, interest margins, and overall economic conditions. Telecommunications companies also contribute to dividend stability. Telecom firms often operate with recurring revenue models, making them natural candidates for consistent dividend policies. Infrastructure and utility-related companies may provide similar income characteristics. For American investors, direct ownership of individual Saudi dividend-paying stocks is limited. Regulatory frameworks and market access restrictions make direct participation impractical for most retail investors. As a result, dividend exposure is typically obtained through exchange-traded funds, or ETFs, that hold Saudi equities. These funds collect dividend payments from underlying holdings and distribute them to shareholders on a periodic basis. When an investor owns shares of a Saudi-focused ETF, dividend income is received indirectly. The timing and size of distributions depend on the fund's structure, sector composition, and dividend policies of the underlying companies. Dividend yields within these ETFs can vary over time. Energy-weighted funds may experience more variable payouts tied to commodity cycles, while funds with higher allocations to banking or telecommunications may exhibit more stable income characteristics. It is important to understand that dividends are not guaranteed. Companies may adjust payout levels based on profitability, capital requirements, government policy, or broader economic conditions. Saudi Arabia's economy remains closely linked to energy markets, and energy revenues influence corporate earnings across multiple sectors. When energy prices are strong, dividend capacity often improves. When prices weaken, payouts may be reassessed. Currency considerations also matter for income investors. The Saudi riyal is pegged to the US dollar, which reduces currency volatility for American investors receiving dividend distributions. This peg provides predictability and limits foreign exchange risk compared to other emerging markets. At the same time, the currency peg limits the potential for currency-driven income enhancement. Investors should view this as a trade-off between stability and upside. Tax treatment is another practical consideration. Dividends received through U.S.-listed ETFs are generally reported through standard brokerage statements, simplifying tax reporting relative to direct foreign stock ownership. From a portfolio construction standpoint, Saudi dividend exposure is typically positioned as a supplemental income source rather than a primary yield driver. Professional asset managers often integrate this exposure alongside other global income assets. Income strategies are most effective when balanced with diversification and risk management. Dividend yield should be evaluated in the context of sector concentration, payout sustainability, and overall portfolio objectives. High yields alone do not guarantee strong outcomes. Sustainable dividends supported by cash flow and prudent capital management are generally preferred over aggressive payout ratios. For American investors, the key takeaway is that Saudi stocks do pay dividends, but access is usually indirect. ETFs provide a regulated and practical way to gain exposure to dividend-paying Saudi companies within a familiar investment framework. Dividend-focused exposure to Saudi Arabia may appeal to investors seeking international income diversification, exposure to energy-linked economies, or reduced currency volatility. As with any income strategy, careful evaluation of risks, payout variability, and portfolio fit is essential. This content is provided for educational purposes only and does not constitute financial advice. For a detailed overview of dividend exposure, risks, and portfolio positioning, download the full Saudi market guide linked in the description.